big fat idea first here. Very pleased to get Patrick Ceresna back with me, Chief Derivative Market Strategist at the Big Picture Trading. Patrick, thanks for finding time for us, and let's get right in it. I know you're talking about gold.
Absolutely. Well, Michael, thank you for having me on the show. Yeah, my big fat idea is around gold and the idea that it will remain bullish throughout the remainder of the year. Now, I'm sure I'm not the first guest to come on this show bullish on gold, and I probably won't be the last. But I really wanted to speak to a particular type of listener out there that, has seen this big rally in gold going from 1,200 to 1,350 on the upside, and they feel they either didn't buy and they feel like they're missing out, or two, they didn't buy enough. And now they feel this anxiety of, well, this big gold move is happening, but I can't buy up here at 1350. And so what I wanted to introduce your listeners to is this idea of using an option strategy to help overcome that emotional anxiety. And the one I'm talking about is called a collar. And the collar strategy involves buying a protective put to hedge the downside risk of getting into gold at these prices, but at the same time selling an out-of-the-money covered call to generate an income to pay for the protection. So it comes almost at no cost beyond commission. The best part, using an ETF like the GLD, an investor can actually do this in an RSP or tax-free savings account.
So let me just quickly, let's say you buy a December 21 put. That means you're protected 121, I should have said. But if gold goes further down, no problem, you get 121. So it only costs you $1 for that insurance. And what would you do on the upside?
Well, see, this is the thing, right? If someone today was to buy the GLD, let's say at just above $127 where it's trading, and you paid $1 for that protection at the $121 strike, which is about 5% lower, you can sell, let's say, a covered call up at the $140 strike, which is about 10% higher than where gold is, and also collect $1 income. So the dollar per share income is paying for the put. Obviously, you still have to pay commissions, but it really comes at no cost, and you've created a really interesting risk-reward proposition.
Well, this is why I've been encouraging right from the get-go people to understand even these straightforward options, what a put is, what a call is, because it's a great example. Let's figure out just very quickly, we only have about 45 seconds. What's the outcome here? If gold stays the same, what happens? If gold goes above 140 or goes down below 121?
Well, exactly. You've created what's called a hedge wrap. You've limited the risk down to a worst-case scenario, 5% loss if the gold completely reverses and heads lower. But at the same time, you've given yourself 10% upside potential if it continues to rally to 140. But the best part is that you're not really frozen there. I mean, if gold continues to rally to 140, you could always, for a small loss, buy back the covered call and still open up the upside of gold. You don't have to stay married to the position, but it allows you to enter knowing what your risk-reward proposition is there.
Well, that's great stuff. Patrick Ceresna, Chief Derivative Market Strategist, Big Picture Trading.